Thanks, Brooke, and thanks everyone for sticking around right to the end in a pretty hot room, I might have to add. Just kind of get a more detailed background on our firm and our team's firm. Our team, you can see in the presentation that my colleague has left on your table, but just in the interest of time, I'll keep that short. I've had 2 decades of long-short experience managing portfolios. The last 6 years at Lumen Asset Management here, we started off as a family office, as Brooke mentioned, for John Bittove, the founder of the Raptors. And the last 4 years, we have opened it up to external investors as well. But the mandate has been exactly the same throughout, whether it's a family office or now as a registered fund. And that is a North American long-short mandate. And by North American, I mean roughly 80-20, US, Canada. And we target annualized returns of 10 to 12% over a market cycle with lower standard deviation, lower volatility, and lower correlation than the markets. And we just fortunately had our 6-year anniversary, and we're fortunate enough to have achieved those targets. On our Class B that I'm presenting with today, we have achieved 11.1% annualized return net of fees in those 6 years. That compares to the TSX total return, including dividends, of 7.1% in that same time period. And again, we have achieved that with lower volatility and significantly lower correlation, less than half the correlation of the overall markets. So how do we manage long-short, our long-short portfolio? How have we been doing it over the past few years? We are, let's do the clicker here. So as the title says, we are change at the margin investors. So specifically bottoms-up fundamental change. So as that quote says, we believe winning begets winning, losing begets losing. So that first positive or negative sign of change, we feel is crucially important in determining alpha generation, especially if it comes with that second derivative or that rate of change. So a company showing its first positive earnings beat, for example, if it's coming with accelerating top line, we're definitely going to look at it from a long perspective, see if those change factors are real, and whether we should include that in our long portfolio. So as that point says, we believe this investment style works because many investors and frankly sell-side analysts, they're lagging indicators. They refuse to see the change that's happening on a stock, even if it's happening right before their eyes. So I'll give you kind of a real-time example. Obviously, this whole COVID-19 thing is roiling the markets right now. If you looked at S&P consensus sell-side EPS estimates as of last Friday, from 4 weeks before that, it had gone down a whopping 1%. Now, the sell-side analysts on the TSX were a little bit more proactive. They had cut it 1.5%. But again, since this whole thing came to fruition, both north and south of the border, they're still talking about double-digit EPS growth rates over last year. I don't think you need to be a stock guru to realize that pretty hopelessly optimistic and frankly lagging. So that's where we feel like we have our opportunity. And that's really how our style is really focused upon. And I call it the antithesis of ego investing, our style, because you have to be ready at a moment's notice if fundamentals dictate to admit that you're wrong and not just go flat, but go the opposite way of a direction, of a position. So in summary, we're trying long securities showing positive fundamental change. We're trying short securities showing negative fundamental change. How do we do this, right? So this is our process. It's a pretty simple step, a 3-step process. How do we identify these change securities? We're looking for all the good things on the long side, right? Accelerating top line growth, right? Raised guidance, strong EPS, strong and sustainable free cash flow and balance sheet, a competitive moat in a business model, right? So earnings season is a great time. Earnings season we just finished. It's a great time to identify these change securities. Once we do that, we then move to step 2, which is the fundamental due diligence. This is where we do our primary research to see if these positive or negative change factors are real or sustainable over time, right? So we talk to management teams, if we haven't done that already in step 1. We talk to sell-side analysts, and that's not for idea generation, but it's really to frame where expectations are for a stock, to gauge where the likelihood of them missing or beating those consensus expectations. Step 2 is also where we do some stuff that I love doing. I really geek out on the accounting and see how aggressive the accounting is or the accounting quality on a company. So a lot of times a company may be, for example, in step 1 in terms of the quarterly reporting. Was that due to aggressive revenue recognition? Were there one-time items? What's the conversion ratio of from EBITDA to free cash flow? So we do a lot of these things, and a lot of things that we identified as change candidates in step 1, actually after step 2, a lot of times we go the completely opposite way, right, when we do this due diligence. Our final step is our risk controls we use to structure the portfolio. We do a number of things here. to make sure that we do have our focus on capital preservation. One is we use quant tools to make sure we don't take unintended risk bets on exposures such as liquidity, size, and industry. I have to stress, we don't think this is a differentiator. Any company worth their salt probably has these software tools. But we do, and we're not going to out-quant the quants, and we're not going to have a proprietary black box that's more proprietary than the next guys, right? That's not where we feel our edge is. But we do feel this is crucially important in mitigating risk. So in a sense, it keeps us honest, right? So there's a summary report in our slide deck that kind of shows you that. If something adds more to our marginal risk in terms of our portfolio, then we really have to like it even more from a fundamental change perspective. Otherwise, we're just probably not even added to our portfolio. Another way we reduce our risk is we keep an eagle eye on our short inventory. We all know the theoretical risk on shorts is unlimited. So we're not going to go into crowded shorts or hedge fund hotels, so to speak. You look at the vast majority of our diversified short portfolio, it's all at GC, which is the very lowest borrow rate that our prime broker, in our case, Scotia, extends to us. So we don't play those crowded trades here. We might think the cannabis industry has the worst fundamental deterioration in a specific stock. We're not going to short that because the borrow right now is 50% on a particular stock and subject to recalls any day, right? Another thing I do in terms of mitigating risk is hard constraints. Right? We've had this since day one to focus on capital preservation. There's a whole bunch of things that we've constrained ourselves from day one as a family office and now as a fund, but I'll focus on two of them as I think key differentiators. One is our very low use of leverage that we've had. As you know, many alternatives, especially in the PE space, you give them your capital and they'll turn that over 5, 6, 7, 8 plus times, right? We don't do that, right? On average, we try to have gross exposures of 150%. So if you give us $1, we will long and short that, we'll invest that dollar, and then we'll also long and short an additional 50 cents. Where we have our grosses and our nets. Every month since inception, we have a net credit balance. So our prime broker cuts us an interest check every month, which is really nice instead of paying margin. So I think that structurally de-risks our portfolio versus perhaps some other classes in the alternative space. Another thing I would highlight would be our liquidity. We're a very highly liquid portfolio because, like I said earlier, if our style means that we have to flatten and go the opposite way of our initial position, if fundamentals dictate, well, I can't do that if it's just 4 or 5 microcaps in oil and gas or whatever, right? So we have a very highly diversified portfolio of roughly 90 to 100 names, long and short. Again, in the more detailed presentation, there's a summary report that shows our liquidity profile in our portfolio. You can see as of now, we can liquidate the vast majority of our portfolio in one trading day with 6 basis points of market impact risk, so crossing the bid-ask spread. So unlike some other alternatives, which arguably have subjective or lagging valuations, this is a real return. This is a real cash return. If we wanted to, we could turn it to cash overnight. So how has all these risk constraints that we put up on ourselves and our process, how has that translated into real world results, right? So there's a lot of metrics you can do in terms of figuring that out, right? To be an authentic hedge fund and limit the downside. One thing, if you look on the top right part of this slide here, we've had roughly 1,600 drawdown days. 1,600 trading days. That would be really bad. 1,600 trading days in the TSX since we started 6 years ago. How many of those days are those really, just Armageddon days where you just want to jump out the window, right? In our case, 1,600 trading days of more than 200 basis points drawdown, we've had 2 of them, versus the TSX has had 15. Another way to look at it is just below that would be our down market years. We've had the market has had 2 down market years in the 6 full years since we've started. One in 2018, the TSX was down 8.88%, including dividends. We were down less than half of that. In 15, it was down roughly the same, down 8.33%. We were up 12.5%. So the only way we could have done these metrics is what I would point to the next part of this slide, right? It's hard to see because it's black background. But what I'm trying to highlight there is our short alpha, right? So unlike a lot of strategies here, maybe some market neutral, some other strategies, right, where you're playing a relative spread on your longs versus your short, and then you gross it up significantly with your leverage, way more than we're comfortable with. What we do here is Our shorts are actually not just a risk diversifier. They are alpha generators unto themselves. They stand alone, right? Which we think in an upwardly trending market over the long term is a difficult thing, and I think is one of our differentiators. On the left-hand side, a number of metrics here. I would just focus on two, the up capture and down capture ratio. So in the 6 years since we started on the up capture ratio, we've had an up capture ratio of 0.71. That means on the days that the TSX has been up, we capture 71% of that upside on average. So obviously, if you think it's going to be beta to the max, and every year it's going to be like 2019, Lumen's not the place for you, right? We are an authentic hedge fund. We do manage the downside. But where we really make our bacon, so to speak, is on the down capture ratio. It's 0.34. So on down days on the TSX, we lose 1/3 of what the TSX does. So in a more normalized cycle of up and down markets, we have outperformed. And this obviously raises the very topical question on what are you doing now with all the turmoil. So year to date, we're up around 2% on our Class B. So yeah, just a summary of a kind of our return performance as we started again. So when you're buying into Lumen, I would just highlight that you're really buying into a track record, I think, of outperformance throughout even the most turbulent times. I showed you 2020 year to date, 18, 15, even going back to my prior life in 2008 at my prior firm, we were positive on our fund, on our flagship fund. And we know how bad 2008 was, obviously. We've done it through a repeatable process with key differentiators of low leverage and high liquidity. And maybe I can finish off like in terms of just how, almost our mission statement, how we look at our firm. We're really focused on being a performance-heavy, marketing-light organization, right? We have a big chunk of, me and my business partner, we have $40 million of our assets in this fund at the same fee structure as all our investors as well. So we're perfectly aligned with you guys. I'm here today, obviously, to tell you about our story, but I can count on the number of fingers on one hand how many of these events we've done, right? We really are focused on being performance first. If you go onto our website, there's a logo, you can click on it. You can keep on clicking, there's nothing, right? So we have raised roughly $140 million of AUM. It's exclusively through word of mouth because we have guys who really believe in our process. And we all know, right, there is a natural trade-off between always trying to be an asset gatherer and performance. And we've seen that time in and time out as funds had early years of performance and fades as they get larger, right? We don't want to be that at all. So with that in mind, we have resolved to do a couple things. We're going to close our fund if it impacts performance. It's surprising on the short side in Canada how quickly liquidity shrinks above the largest names. So we want to constantly, on an iterative basis, these liquidity reports. When it really starts impacting our process, we will close it down, and you can have my word, we will never reopen it. On probably the final thing is we have one product, right? We're laser focused on that one product, a long-short mandate. So we're not going to launch whatever the flavor du jour is right now. We're not going to have a private distressed, debt fund or whatever, right? That's not where my edge is. I'll leave it to a lot of smart guys in this room that were already presented to do that. We know where our edge is, which is 20 years of managing long-short money, right? Consistently across some of the worst down cycles. We've been very, very early on in terms of the hedge fund industry in Canada, in terms of our experience, and we've seen a lot of rough times. So we feel, especially in an economy as structurally challenged as Canada, like there always will be a need for a true hedge fund that generates a proven track record of short alpha and mitigates the downside. So I don't know how much time I have, but for questions.
That's great. Thanks for that. That's you've demonstrated that you can own a piece of equity and get returns out of it, but actually reduce your risk in that single slice as well as portfolio. All set. So well done. Thanks for that. Question for you in terms of the long-short strategy and thinking about all the long-short strategies out there. We talked about this earlier. There's different sort of flavors of volatility. What sort of volatility works for you guys, and what sort of volatility does not work for you guys?
Yeah, that's a fair comment. I mean, I think we have seen in our down capture rate, like in turbulent times, we have outperformed in times of very high volatility, like we see now. So that is where we really, again, as I say, make our bacon, right, with our 1/3 down capture ratio. Where I think we kind of underperform are times like late stage in a bull cycle, for example, right? we pride ourselves on our selection effect. That's where our alpha has been generated, right? So when that's not being rewarded, that's when we get hurt. So in a late stage of a bull cycle where everything is to the moon, right? Multiples expand. I had a bunch of shorts, that showed terrible quarters, cut guidance. They were down a day late last year, and they were right back up at records, right? So that's a time when we underperform, when idiosyncratic risk is not being valued, right? When it's just common factor risk. So when we see that on our quant reports, we're always trying to focus, again, with an eagle eye on stock-specific change at the margin.
One more quick question. Concentration in the portfolio.
Mm-hmm.
Can you just give us a measurement of that, and then attribution on the, say top holdings or your top 25 or 40% or whatever?
Yeah, we've, if you look at our presentation, I have an attribution report, and you see that we've made money in all 11 sectors of the S&P TSX since we started. We've made money on the longs and shorts, like I said. We made money in North America, right, in Canada and US. Obviously, the focus is on Canada. So however way you slice and dice it, we have made money, and we think that is repeatable over time. We have a very diversified portfolio, roughly 90 to 100 names, long and short. And you look at our attribution in terms of single security, we don't have homers. It's all singles, rinse and repeat, over and over. If I showed you a single security attribution report, it'd be this thick, right? Because we don't try to swing for the fences. We never have. That's not in my DNA. Sorry.
Thanks, Tim. And again, last question, panelists. Again, what client would be appropriate for this fund?
Well, I'm repeating myself, but again, a client who wants to own equity but wants to have some risk protection in place for times like currently and whatever's going to happen in the future. You're providing returns, great returns, with an element of protection along the way. So you're striking the balance. Cake and eating it too.
I would.
Okay. Thanks, Tim.
Thank you.